Is Sydney back into property boom territory? That's one of the questions I'm going to ask Dr. Andrew Wilson in today's Property Insider video. We're also going to talk about what's happened to auction clearance rates, what's happening to rentals, the latest Reserve Bank commentary and what that means for interest rates, building approvals, loan approvals, lots of news. So if you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so you can be kept up to date each time a new show comes out. Is Sydney back into a property boom? It's well known the perfect storm for property price growth that we experienced last year won't be repeated in 2022. The once-in-a-generation boom that we enjoyed last year was underpinned by historically low interest rates, by pent-up demand, and by a reassessment of housing preferences during COVID-19. But now many commentators are predicting house price falls later this year or early next year, and they think that's going to be caused by rising interest rates and housing affordability issues. In fact, in the closing months of 2021, last year, our two biggest housing markets, Melbourne and Sydney, slowed down lower auction clearance rates, slower price growth, more so than our smaller capital cities. But with data in for the month of January and a couple of auction weekends under our belt, the Sydney property market's proving stronger than many gave it credit for. That's one of the topics I'm going to discuss in this week's Property Insider Chat with Dr. Andrew Wilson, Chief Economist of My Housing Market. We're also going to bring you up to date with a whole lot of other property news that happened over the week, including statements from the Reserve Bank, what's happened to home loan and building approvals, what's happened to rentals around Australia, and the weekend auction results. So we've got a lot to discuss. Welcome, Andrew.
Yes, hello, Michael, and it's been a very positive start to the year as the data is coming through as we expect the market to start to pick up once we move into February. It's probably looking at more on the surprising on the upside, particularly to those that have been predicting house price crashes. They might be sooner rather than later revising those predictions for falling house prices this year, because it has been quite a robust start to the year and it's gathering some momentum.
Well, as we said, Sydney's market started to slow down at the end of last year, but has really commenced 2022 with continuing solid buyer activity, despite all the restrictions of COVID and all the concerns around that.
Yeah, January was quite a solid month for the Sydney market, Michael. Of course, we are distracted over January with the usual holiday issues, and it is the quiet part of the year. And also we've had that exacerbated by what's happened with COVID, unfortunately, with a lot of concerns there and some restrictions as well. But it hasn't really slowed down the housing market, and that's the same pattern we saw last year, of course, and the year before. There's been quite robust numbers of Sydney sales for houses over January, and the leading areas have been the western suburbs and the southwest of Sydney, where there's been a number of sales occur for houses. But it's interesting when we look at the median prices for houses sold in the west and the southwest, they're just under $1 million now. So they are the most affordable areas in Sydney, and even the most affordable have just under $1 million. And I think that tells the story, really, is why we're seeing so much action in those areas. And remember, I'm talking about established houses here, not new houses, because they are areas where there is a lot of new development happening. But even with established properties, there's plenty of buyer action in those western suburbs and southwestern suburbs. And I think that what that reveals, of course, is the underlying issues with affordability in the Sydney market. And that's where buyers obviously are gravitating to the more affordable established areas down to the west and southwest. But certainly Sydney's had a very positive start through January to its housing market. And that's been, of course, highlighted last weekend, the first weekend for the auction market in February. And it's, I guess, in a sense, the first significant test, maybe not totally significant, because we will get numbers rising quite sharply over the next few weekends in the auction markets. But Sydney had a plus 80% clearance rate to start February, which really is quite astonishing. It's its highest clearance rate since last October. And it came despite another record early February day for auction listings. So surging numbers of listings haven't slowed the market down. In fact, the buyer appetite seems to be unquenchable at the moment, Michael. But yeah, things are very positive in the Sydney market at the moment.
If we look more nationally now, Andrew, there seem to be rental shortages, and over January that drove rents higher.
Yes, look, I think this is really a serious issue, Michael, and it has been for quite some time. And we don't sort of have that much focus, and with our policymakers as well, on the rental market. But you've got to understand that tenants make up around 40% of the housing market, and we've seen another decline in vacancy rates over January, and more specifically, national rents have now increased at just under 10% over the year to January, and most capital cities are recording strong increases in house rents. The one exception is Melbourne, but even Melbourne's vacancy rates for houses are now starting to tighten, and its decline in rents is not as it was. So I think we have a real issue here, which could become quite a significant social issue, and that is the shortage of rental accommodation in Australia. And that's not going to be fixed anytime soon. It's very hard to address those imbalances between demand and supply. And of course, we have to remember, Michael, that with borders opening up, fingers crossed, we're going to see a surge in migration into this country, which will only increase demand, particularly for rental properties. Where's everybody going to live?
Well, we know that the overseas migrants in particular start off in Melbourne and Sydney, and in general in apartments rather than houses. What's happening with the apartment rental market, Andrew?
Well, similarly, we're seeing increases in apartment rents everywhere except Melbourne. Sydney rents are now starting to rise for apartments. And I think that even the vacancy rates in Melbourne and Sydney for units have started to tighten. They're still quite high, as we know they have been for the past year as a result of various issues, increase in supply, and of course, reduced demand. But I think that those markets particularly will see a surge in activity once borders open up, particularly from students, Michael. And there's a lot of pressure for the government from the education sector to get those student numbers back up and running. And of course, that will increase demand significantly into those inner city apartment markets. So I think that it won't be too long before we start to see rents rising in Melbourne in the apartment market, despite still having quite high vacancy rates there. And we're talking the CBD, of course, here in Melbourne. Other than once you move out of the CBD, vacancy rates are quite low for units and apartments in suburban Melbourne.
And of course, the Reserve Bank can't stay out of the news. The media loves hearing what Philip Lowe has to say. And last week in the Statement of Monetary Policy, the Reserve Bank confirmed its significant reassessment of inflation and the unemployment outlook, but it also reminded us to remain patient. But it believes unemployment could fall below 4% by the end of this year, Andrew. It thinks inflation is going to remain close to 3%, and our economy is likely to pick up back to pre-pandemic levels. Are they now going to reassess their forecasts of when interest rates are going to change?
No, they're not, Michael. Nothing's changed really, and I'm not sure there's anything greatly significant. Poor old Philip Lowe seems to be a little bit under pressure at the moment because everybody's trying to beat that higher interest rate drum. It's really becoming quite silly at the moment. We will await the end of February's data on the wage index. That'll tell the real story. And I still believe there won't be much energy in higher wages that will drive the conversation towards what seems to be now most predicting almost a certainty that interest rates will rise this year. And some are now even predicting May interest rate increases. But we've still got to get through COVID, Michael. The impact on COVID over the first part of this year is yet to be revealed in economic statistics. It would be quite astonishing if we had still falling unemployment rates with all the issues over COVID, and particularly would be even more astonishing if we had higher wages in that environment as well. But that data won't be revealed for the best part of 4 months. So the Reserve Bank really has no option but to be patient and wait for the data to come through. And it's quite clearly and consistently said that it needs to have a sustained period of higher wages growth above 3%, which we haven't had for over a decade, before it would consider raising interest rates. But media and perhaps a number of commentators seem to be blind and deaf to the logic of all this. And maybe it's just because, well, it's a hell of a great headline, isn't it? Higher interest rates. And once you're addicted to that, well, it's very hard to get off it, even if the underlying data clearly tells you that there's some way to go. But we will see. And as I said, Michael, it all will be revealed at the end of this month when we get the wage index data. So let's wait and see what happens there. But I've just got a feeling that there's going to be a lot of revisions happen to those forecasts for higher interest rates and lower house prices following the wages data. And regardless of that, we must remember that wages data will reflect the December quarter, and we still have the hurdles of COVID to get over through the March quarter.
Over the week, there's been lots of other news too. Dwelling approvals rose 8.2%, but house approvals fell. Apartment approvals rose. Now, Andrew, we know that there's a shortage of new apartments, but apartment approvals seem to be much more volatile. They come in big waves, don't they?
Well, that's right. It's a lumpy series, Michael, because we do get large developments coming through from month to month. So we need to look at the underlying trend. But apartment development is still significantly lower than at its peak. We're talking about the underlying trend here, that its peak back in 2015-16. And that's one of the reasons why we do have rental shortages, because of the overall shortage of housing. A lot of that was, as I constantly say, as a result of those the credit squeeze action on investors. That's reduced our rental stock particularly. But it's interesting to see we do have a revival in apartment development, Michael, and we look a little deeper into the data. We can see it's actually Melbourne and Sydney, particularly Melbourne, interestingly enough, has seen a recent surge in larger apartment developments. So that's some good news for the Melbourne economy, of course. But Sydney as well has been approving some significant apartment developments. Still not back to the levels at its peak, but certainly the trend is a little bit more positive for apartment development coming out of Melbourne and Sydney. But as you said, the housing approvals for houses has flatlined, and we shouldn't be surprised at that, given the very strong activity we had as a result of the Home Builder Initiative last year. And that's worked its way through the system now. And I guess we're back into a normalised environment in terms of house approvals. But yeah, apartments picking up. It's still a long way to go before they get back to the higher peak levels of that we recorded a few years back. But yeah, Melbourne and Sydney are starting to consider getting back into apartment development. But the point is that it'll be some time before those apartment approvals become actual dwellings that people can live in.
Sure, there's a much, much longer lead time to get apartments financed, pre-sold, out of the ground, completed, and eventually bought or tenanted. So houses are much quicker to build. So there's going to be rental shortages for quite some time.
Yes.
On the other hand, the housing loan commitments were strong, the last ones shown for December.
Yes.
Not surprising, but that's also now translating into people with loans ready to buy a property,
Yes.
and that's showing in the markets.
Yeah, look, you're right, Michael. And we did have another reasonable month over December. Of course, there is some catch-up happening with those. November was a spike, of course, and it's followed up by another increase over December. But of course, that did follow a dip in the previous months as a result of lockdowns. So that was to be expected to some degree, but perhaps it's holding up a little stronger than we thought, in the sense that affordability had been starting to push buyers out of the market from high house prices, of course, particularly Sydney and Melbourne. But that's still holding up. And I thought what was interesting also, Michael, was that it was owner-occupiers and first-home buyers that really led the charge. Investors were still quite solid, but it has been investors that have been the strength of the market over the 6 months ending December last year. But it was, again, that surge in owner-occupiers and first-home buyers that pushed the results up again in December. And I think it's not just catch-up. I think there's still some appetite there to be in the market. And I think we're seeing results of that now, as you said, with those finance approvals moving their way into actual purchases. But I do think one of the interesting factors is first home buyers are still holding up, Michael, despite these strong price increases and price increases continuing. First home buyers, of course, are exposed to higher prices more than owner occupiers, because owner occupiers have the trade-in, so that their trade-in property, their changeover property, can keep up with the market theoretically, whereas first home buyers are restricted to saving for their deposit. So you would have thought higher prices would have had more of an impact on first home buyers than they have had, but those numbers are standing up. And of course, a lot of the benefits that first home buyers have had, such as stamp duty discounts and the first home buyer deposit scheme, are no longer available at the same level. But nonetheless, first home buyer market share is still above the long-term average. And I think that just reflects to some degree that there are other sources of finance that first home buyers are activating. And I think that's, and again, this intergenerational wealth shift thing that's happening from the bank of mum and dad to some degree. And first home buyers are still very, very keen to be part of the Australian housing market, Michael, despite really having to struggle to keep up with higher prices.
But that's great news, and the sacrifices they make today will be paid back over the generations as the value of the house improves. Interestingly, as this chart shows now, the increase has taken home loan approvals to new record highs. Interestingly, approvals are up 71.6% over their pre-pandemic levels 2 years ago in February 2020. So that's all good news for the property markets, and it's played itself out in the auction markets over the weekend. How did the auction results go around Australia, Andrew?
Well, a very strong weekend for auctions, Michael. We alluded to the Sydney market previously, but Melbourne also had its highest clearance rate since November. And it was despite high numbers of, as we would expect, of course, higher numbers of auctions moving into February compared to the end of January. But auction numbers have been quite high in the smaller capital cities, Michael, Brisbane, Adelaide and Canberra, and which are quite high for this time of the year. And their clearance rates were again all above 80%. In fact, all housing markets produced clearance rates above 80%, with the exception of Melbourne. But the Melbourne trend is upwards, and the Sydney trend is also clearly upwards. So this has been a real bounce back this year from particularly from Melbourne and Sydney, despite all the issues still with COVID, the concerns and the restrictions. So, of course, the more challenges will be coming through in coming weekends, particularly in Melbourne, where auction numbers will rise very strongly until the Labor Day long weekend, which is the first weekend in March. And there's always presents, which is the first Super Saturday of the week of the year, of course. And that will present challenges. So all will be revealed then, Michael. But so far, it's still very much a seller's market Australia-wide.
Well, what a great start to the year. We'll be back each week to give our thoughts on what's happening, and look forward to seeing you then.
Thanks, Michael.